Welcome to the Market Mosaic, where every week we are breaking down the intersection of macroeconomic data, market technicals, and market internals, things like breadth and sentiment, to try to figure out where the market could be headed over the near term. And here we go once again, right? So geopolitical risks are flaring up. That's igniting a fresh round of tensions between the U.S. and the European Union. We're now seeing new threats of tariffs and the trade war coming back into the headlines again. So, following President Trump's move to implement a new round of tariffs on European nations that are opposing his desire to acquire Greenland, the European Union's hitting back. They're threatening to scrap the trade deal reached with the U.S. following last spring's trade war and maybe some other retaliatory measures as well. And you're seeing, because of that, a broad risk-off move. You see stock index futures are trading sharply lower, the dollar selling off, and you're seeing precious metals rally. So here's the gold chart on here. Gold prices popping out to a new record high over the $4,600 per ounce level. Just an incredible run that we've seen in gold prices. The last big consolidation we had was from this April through August timeframe, and the breakout out of that sideways trading pattern has remained above the 50-day moving average. This black line on here, we've come near it a couple times to test, but the uptrend remains strong, and gold prices are making a record high off geopolitical tensions. And look, this is investors are going to be fixated on this to start the week. We got this prospect now for rising volatility around tariffs and the geopolitical headlines, but you got to remember that the recent market action has remained extremely bullish to start the year. So small cap stocks are on a notable win streak against large caps. We'll get into that more in just a second. Cyclical sectors are building on breakouts. I talked about transports last week. And majors of the average stock continue making fresh record highs. And here's one way you can look at that. This is the cumulative NYSE advanced decline line. So if you take the daily advancers minus decliners on the NYSE, add it to the prior day's total, and you create a running tally of that, that's what this line on here represents. So it's a way to track the performance of the average stock. And you can see this is a dip on Friday where the markets are closed on Monday. You can see we've held near highs and building on this move out of a basing period that lasted from about September into the start of the new year. And so to see this kind of leadership in the average stock, that is a big change in character for the stock market. Past leadership has been concentrated in mega cap stocks leveraged to the AI theme. And several of those stocks remain well below the record highs, and because of concentration in the S&P, that's weighing on the major indexes. We'll talk about that more in just a second. But another key development you want to keep an eye on is what is happening with commodity prices. So gold and silver is getting all the attention, but a recent breakout in broader commodity indexes has a big implication for the inflation outlook. Oil's been rallying recently. We've had this huge move in natural gas here today, and so this week, what I'm going to do is look at the strong start to the year for the average stock and what I think is a key factor driving that performance. And I also want to take a look at seasonality, or look at the S&P 500's path during midterm election years. And we'll talk about that breakout in commodities and why you should be watching that carefully. All right, a strong start to 2026 for the average stock. And you're seeing that in small caps. It is sending small cap stocks on a historic win streak. So the Russell 2000 index, it's an index tracking small caps, is outperformed the S&P for 10 consecutive sessions. So these red bars down here can track consecutive sessions in which the Russell 2000 is outperforming the S&P 500. You can see last week we hit a 10-day win streak, and that is the longest streak since 1990. But, it's cool to see the day-to-day, the streak in small caps, but overall, big picture, there could be a lot more upside for small caps, at least relative to large caps, because the top painted on here, this shows the relative price ratio between large caps and small caps. And so a falling ratio means the Russell is underperforming the S&P 500. A rising ratio means the Russell is outperforming. You can see sustained underperformance. Look how far back this goes. So over the past at least 10, 11 years, after this ratio peaked, we've been in this downtrend of large caps outperforming small caps, bringing this ratio down to the lowest level since the internet bubble. And so, last time we got down around these levels, we saw a sustained move higher in small caps relative to large caps. So keep an eye on that this time around as well. So relative price valuations show that small caps are cheap, while an accelerating domestic economy could be another boost as well, could be an earnings boost. So small caps derive a larger share of their revenues and earnings from the domestic economy relative to the S&P 500. If you look at the S&P, around 40% of sales come from international sources, so small is much more leveraged to the domestic economy. And we've seen strong growth figures. Recent GDP for the third quarter that came out at a 4.3% annualized pace. The Atlanta Fed's GDP Now estimate for fourth quarter GDP is running at 5.3%. And strong growth could persist into this year because there's a lot of pressure to onshore key industries, and we still have this data center build out, and that is fueling a CapEx boom. That's what this chart on here is showing. It shows the year-over-year change in CapEx shipments. That's the orangish brown line on here, and new orders is the green line. And you can see this is an overall trend of accelerating year-over-year growth going back to 2023, but just really picking up and hitting new highs recently. And so that CapEx boom is something that can fuel the domestic economy. And again, small caps could be more leveraged to that trend relative to large caps. All right, so while small caps are on a winning streak relative to the S&P, lagging performance in just a handful of stocks could significantly impact the S&P 500's return. Many members of the Magnificent Seven, they're leveraged to the AI trade, and they're recently struggling. They remain well below their prior highs. A couple examples. Microsoft is 16% off the October peak. Meta Platforms is 22% off the highs seen last summer. And so the biggest names in the market are lagging. That could weigh on the broader cap weighted indexes because of concentration. So the top 10 stocks in the S&P makes up 41% of the index at the end of 2025. I mean, it's pretty much a record. Their earnings contribution is about 32%. You can see these numbers in this chart. So at the end of 2025, the top 10 market cap just under 41%. Their earnings contribution, the weight of earnings, is about 32.5%. And so if you're trying to monitor and gauge the broader performance of the stock market using cap-weighted indexes like the S&P 500 or the NASDAQ, they could be telling a different picture than what's actually going on when you have concentration running at these levels. The S&P is susceptible to recurring seasonal patterns over various time intervals. We talk about these things a lot. Some specific months are known for posting large average returns with a high win rate. You have longer periods like the sell in May go away. That's a 6-month stretch associated with weakness. We can also track how the S&P tends to move during the 4-year election cycle. So the chart here plots the average price movement of the S&P 500 depending on which year of the election cycle we fall in. So the election year, post-election year, midterm, and pre-election. And this is tracked, and you can see the black line is how it tracks on average. The red line is how it's been actually tracking. And you can see it's tracked fairly well this time around, especially, I would not focus on the day-to-day squiggles as much as I would the overall trend and key turning points. So like this pullback, you saw a peak early in the year last year and a pullback into the spring. It was a larger magnitude than what we see on average, but it followed kind of that trend and the dates that mark those turning points. And so fast forward to now, and if this cycle continues tracking, you would expect to see more choppy price action in the S&P 500 before you get a little quick burst of upside into April, but then a more sustained pullback into September. So just a couple things to have in mind and keep an eye on when it comes to the S&P 500's performance against the election cycle. So we have a key breakout that could be underway, and that is with the broader commodity indexes. So headlines have been focused more on the move in precious metals or the shortages in key base metals like copper. But we've had a recent rally in oil prices in particular is helping push broad commodity indexes above a key level. And you can at least see that with the ETF on here. This is the S&P GSCI ETF. This is a weekly chart going back 5 years, and the arrow shows this breakout I'm talking about, poking above this $24-ish area. But this would be, if this holds, this is a move out of a very significant pattern. This is an ascending triangle pattern, so it has the common resistance area around that 24 level, higher lows along the way. And why this would be a significant breakout is because this is a very lengthy consolidation. This originally started back in 2022. So we've been creating this pattern, carving this pattern out since then, and this has big implications for the inflation outlook. This period of rising commodity prices right here, this is that first inflation wave we had in the mid-2022, and look what happens. Commodities peak out in mid-2022. That's when you had inflation peak out, the year-over-year rate at least, and a disinflation trend come in. So if we see commodities start to sustain a move over this level and build on some of these more recent gains, and that could be, that could have some really big implications for the inflation outlook ahead and really challenge expectations around what the Fed can do with rate cuts. All right, so holiday shortened week. We have markets closed for MLK Day. Some notable events coming up on Wednesday. President Trump speaks. I believe this is at Davos, so we'll see what he says, especially in the context of some of these trade tensions, trade war headlines, and tariff headlines making the rounds once again, and his desires around Greenland. So we'll see if anything new comes out there. Otherwise, the other big event I would watch for this week is with the PCE index. So this is the Personal Consumption Expenditures Price Index. It's the Fed's preferred gauge for measuring inflation. And right now, you expect to see a small tick down in the year-over-year rate of change in the core PCE index. So keep an eye on that. And if there's potentially any surprises there, big picture is that the disinflation trend off of the mid-2022 peak in inflation has stalled out for the last year or so now, around the 3% level. So just keep an eye on some of the underlying components within that could suggest inflation is still stalled out here if we're going to see a change in direction. All right, one name that you have to keep an eye on this week is with GE Vernova, ticker GEV. That is because not just this stock, but because late last week, there was just this burst of activity in infrastructure stocks. So whether it's construction infrastructure, energy infrastructure that GEV participates in more, there was just a broad burst of upside. And when that happens in a specific industry, you need to sit up and pay attention. So what I would watch for with GEV on here is that originally we were tracking this pattern where we were testing resistance right around, I think it's about the 650 or so level, several times going back to summer of last year. We had this big move, this big breakout over that level. The MACD was extended. So what does that tell us? Tells us that there's mean reversion potential, and that's exactly what happened. The stock came in, filled the gap, but was creating a new basing pattern. So this looks more like a base on base pattern. And we're having the stock, after getting a bullish MACD reset the zero line, stock started to turn back higher again. So again, turning higher with the rest of the industry. And so what I want to watch for with GEV is if we can see a breakout out of this pattern to new highs. So watch for that with GEV. All right, that is all for this week. Thanks for tuning in.